How the rich invest. Stop investing like everyone else. If your investment strategy depends on headlines, YouTube predictions, or what your mate at the golf club bought last week, you're not investing. You are gambling, but with better branding. Here's the uncomfortable truth. The wealthy do not build fortunes by chasing noise. They build them by ignoring it. They are not looking for the next rocket stock. They are not reacting to every budget announcement. They are not refreshing their portfolio app every afternoon. They follow a structure, a philosophy, a repeatable system. In this episode, I'm going to break down exactly how they do it. Not theory, not hype, but the core principles that underpin serious wealth. Risk alignment, time in the markets, diversification done properly, cost discipline, evidence-backed tilt towards smaller and value companies, thoughtful use of commercial property, and behavioural control. Because wealth is rarely destroyed by markets. It's destroyed by ego. Wealthy investors start with one question. The first question wealthy investors ask is not, what should I buy? It is, what am I building towards? If you do not know what the money is for, your portfolio has no anchor. And without an anchor, every market wobble feels like a catastrophe. Serious investors reverse engineer their strategy from their life. Selling a business in 5 years requires one structure. Funding generational wealth requires another. Retiring at 55 demands something else entirely. The portfolio is not the starting point. The life is. Your life is. This is where most people go wrong. They collect investments. The wealthy construct strategies. When your investments are aligned to a clearly defined future, volatility becomes context, not panic. Clarity removes drama, and drama is expensive. Risk is not the enemy. Ignorance is. Most investors say they are comfortable with risk until markets fall 15%. Then suddenly the long-term plan becomes negotiable. Here is the reality. If you want growth above inflation, you must accept exposure to assets that fluctuate. This is not optional. That is mathematics. Cash feels safe, yes, but over 20 years, inflation quietly erodes it. That is risk too. It just hides better. The wealthy understand this. They define an appropriate level of risk based on time horizons and capacity for loss. They blend growth assets with defensive assets. They expect downturns. They do not build portfolios that only work in the sunshine. They build portfolios designed to survive storms. Because volatility is not a design flaw. It is the admission fee for long-term returns. Timing the market is an expensive hobby. Let me be blunt. Trying to time the market is one of the most reliable ways to underperform it. The strongest recovery days often sit right next to the worst declines. Miss just a handful of those recovery days over a decade and the damage to long-term returns is severe. And here's the problem. No one rings a bell at the bottom. Wealthy investors understand this. They stay invested. They rebalance where necessary. They do not attempt short-term predictions because evidence does not support it. Time in the markets compounds. Time out of the markets disrupts compounding. If you are constantly jumping in and out, you are interrupting the very mechanism that creates wealth. Patience is not passive, it is strategic. Diversification is discipline, not decoration. Owning 5 UK stocks is not diversification. Owning one global fund without understanding exposure is not diversification. True diversification means spreading capital across thousands of companies, across geographies, across sectors, across asset classes. It means accepting that you do not know which region or style will outperform next year. The wealthy do not bet on one story. They own the global economy. And when one segment underperforms, they do not panic because another may lead. Diversification will never feel exciting. It will often feel boring, but boring is powerful. It reduces concentration risk, it smooths volatility, it increases the probability of consistent long-term progress. Diversification is humility expressed financially, and humility compounds. Fees are silent wealth killers. No one brags about low fees at dinner, but over 30 years, fees can quietly carve away hundreds of thousands of pounds. 1% here, 1% there, compounded annually. That's not trivial. Wealthy investors scrutinise costs because they understand something simple. Markets deliver returns before costs. Investors experience return after cost. The difference is everything. They avoid excessive trading. They avoid high-cost stock picking strategies that lack persistent evidence. They favour systematic, structured exposure. Because every pound not lost in unnecessary fees remains invested, and capital that remains invested compounds. Cost control is not about being cheap. It's about being intelligent. Evidence beats opinion every time. Forecasts make great headlines, yes. They rarely build great portfolios. Decades of research across global markets have identified persistent drivers of long-term return. Smaller companies have historically delivered higher expected returns than larger ones. Companies trading at lower valuations relative to fundamentals have historically produced a value premium. They are not predictions. They are observable patterns repeated across time and geography. Disciplined investors do not bet the house on them, but they tilt towards them thoughtfully, systematically, with control. This is not stock picking. It is structured exposure to risk premiums. Opinions change weekly. Evidence endures. And wealthy investors choose evidence. Commercial property has a role, yes, but not a pedestal. Commercial property can be powerful, income streams, tangible assets, diversification benefits, but it's a component, not a religion. The wealthy assess how property interacts with the wider portfolio. They consider liquidity, they consider concentration, they consider correlation. They do not overload simply because it feels concrete. Everything has a weighting, everything has a role. When commercial property complements equities and fixed income intelligently, it can enhance stability and income characteristics. But discipline still applies, because concentration risk dressed up as confidence is still concentration risk. Structure always wins over enthusiasm. Your behaviour is the real risk. Let me say something that might sting. Your biggest investment risk is not inflation. It's not geopolitics. It's not interest rates. It's you, my friend. Selling in fear, buying in euphoria, abandoning strategy mid-cycle. The wealthy protect themselves from themselves. They build processes, they rebalance systematically, they rely on structured philosophies rather than gut feeling. Because emotional decision-making destroys compounding faster than any recession. Markets recover, panic decisions rarely do. Quiet confidence is not about being calm because nothing is happening. It is being calm because you expected this to happen and your strategy already accounted for it. This is how serious wealth is built. So how do the wealthy invest? They define the outcome before selecting the instrument. They align risk to time frame and purpose. They stay invested through volatility. They diversify globally and structurally. They control costs relentlessly. They tilt towards evidence-backed risk premiums. They incorporate complementary assets thoughtfully. They master their behaviour. None of this is flashy, but over decades, this is how serious wealth is built. Quietly, deliberately, systematically. Not through brilliance, but through discipline. If you want to invest like the wealthy, stop chasing noise. Start building structure. That is investing with quiet confidence.